Hi everyone, I'm Ravi Handa and welcome to another episode. Today I wanted to talk to you about one of the most basic, one of the most fundamental concepts of personal finance. What most people do is they keep on bothering about, where to invest, what returns I will make, etc., etc. All of those are important decisions. But the first step that you need to do before you make even 1 rupee of investment is you need to kill your expensive debt first. What I mean by that is debt is not necessarily a bad thing. You have taken a loan, you are paying an interest, perfectly fine because you didn't have that money. But a lot of people make a mistake in this. What they do is they get caught in the credit card trap. What is the credit card trap? Typically, what happens is having a credit card makes you spend more than you actually should, which in some cases, having that credit is a good thing because it expands your ability to spend. The problem that happens is the amount that you owe the bank via the credit card is on a very, very high interest rate. Sometimes it is as high as 2%, 2.5%, 3%. Now, you might be thinking that 2% and 3% is not that high, but it is not 2%, 3% a year. It is 2%, 3% a month. And that can balloon up to something like 35% or 40% a year. So the first thing that you should be doing if you are in that sort of a loop is kill that expensive debt first. Please pay your credit card bills on time. And I used to think that it's obvious. Everyone will be paying their credit card bills. Why would someone carry forward their credit card bills? But that is not the case. I was going through the SBI cards data, and since they're a listed company, they put it out publicly and you can check it for yourself and you can see it on the chart here as well. Over the last few quarters, at least the ones that you can see on the chart, more than half the people, more than half the people are not paying their credit card debts. So what they end up doing is A, they might be paying some sort of a minimum balance which is required, or B, they will be converting some the outstanding amount in form of an EMI. Now, even if you convert the outstanding part in the form of an EMI, you're still paying a very high interest rate, which could be anywhere from 15% to 18%. And there are roughly 25% of people who are like that. But there is another 25% people who are revolvers. Now, you might be one of the revolvers. You might not have realized that you are a revolver. What is a revolver? The person who just pays the minimum amount balance. And credit card companies trap you. Whenever you see a credit card bill, what they will do is they will highlight the minimum amount due, they will put that amount in bold, and they will not highlight the total outstanding amount. Why do they do that? Because they want you to pay the minimum amount. Why do they want you to pay the minimum amount? Because they want to charge you that 35, 40%. So please don't get involved in that trap. Please pay the entire amount if you can. Now, I fully understand that you might be in a situation where you are not able to pay the complete amount. Well, in that case, the first thing that you should do is at least convert it to an EMI so that you are at a lower rate. An even better thing that you can do if you are in such a case is wherever you have your main account, your salary account, you go to that particular bank and ask for a personal loan. You take that personal loan and repay this credit card debt. Typically, the personal loan that you will take will come at a even lower interest rate. The other problem that I've seen with a lot of people is that they sometimes have FDs, they sometimes have stock market investments, they sometimes have mutual fund investments, and they will still keep paying these high interest per EMI or per personal loans, or even they still revolve credit because no, I don't want to break that FD, or no, I have this money for my child's education, I don't want to touch that. Don't fall into that trap. If you have any sort of money, be it in an FD, be it in stocks, be it in mutual funds, whether it is at a loss, whatever scenario it might be, please break that investment and pay this debt. Because you might be thinking that if I break the compounding, I might not make super returns. Yes, you won't. But here, you are paying 40% interest. So just by repaying this amount, you will be getting a 40% return. So don't wait that when my financial situation improves, that is when I'm going to pay the debt. If you can convert it to a personal loan, if you have any money lying anywhere, please break that money out, put it in the credit card debt, and get away from the expensive debt. So the one thing that you should take away from this video, have a look at your credit card bill. What is it that you are paying? And if you have that high expensive debt, kill it.